Hey guys, in this video, we are going to show you a trading technique that combines multiple time frames to get a well-informed trade execution with smart money concepts. The process of executing a successful trade begins with analyzing the higher time frames and zooming into the lower details to identify trading opportunities. There are three types of time frames, each serving a specific purpose. Firstly, we have higher time frames, such as weekly and daily, which we use to determine the overall market direction and identify key levels. Secondly, we have analysis timeframes, where we conduct most of our analysis, including applying concepts such as identifying market direction, fair value gaps, order blocks, liquidity areas, and potential trading opportunities. Finally, we have entry timeframes of 15 minutes and 5 minutes, where we seek confirmations before entering the trade. As we begin our analysis on the 1-hour chart, our initial step is to outline the market structure schematic to understand the market direction and structure. This schematic is sketched from the lowest point to the highest points of visible swings. For example, here this could be the schematics of market structure swings for this pair. Now, you can also draw some internal structures onto the chart as well. However, the primary objective of sketching a schematic is to observe the recent movements of bulls and bears in the line chart to get a clearer understanding of who is in control. Every reaction to a certain price level could be considered a swing. However, the strength of a price movement is determined by the distance it has pushed, the imbalance, and the rejections through wicks. Now, in order to make the schematic drawing non-subjective, we have specific rules for identifying the major swings, through which we obtain the general market direction via these levels. Let me walk you through how we identify these major swings.
Automated Trading System, ATS, Trading Results. Join my Telegram channel right now. Don't miss out on the ATS system.
Here we see a sharp bearish movement establishing a low, which we mark on our schematic. To identify further swings, we wait for the price to break and close below the previous market structure. The peak point between these consecutive lows becomes our major high. Now, we can accurately draw the schematic. These lines represent the major swings, while anything between them constitutes internal structure. It's important to note that our trend identification primarily relies on these major swings. Following this, we wait for the price to either break the high to the upside or the lower low to the downside. Once again, the peak point between these consecutive lows becomes our major high. Next, we can see that the price has broken the swing high to the upside. This indicates a shift in the market structure, because the sellers have failed to hold this level, and now the buyers have taken control. So we have a new high. Subsequently, the price breaks this high to the upside. Therefore, the lowest point between these highs is considered our major low. As I mentioned, these are considered the major swings that our directional analysis relies on. Anything between them is considered the internal structure or minor swings, but sometimes they can also provide valuable trading information and opportunities. For example here, this marks the beginning of the latest bearish impulsive movement. However, the origin point of this imbalance is these candles. So, the supply order block is located here, and if the price returns to this level, it could offer a great trading opportunity. On the other hand, if the price manages to break above this extreme supply level, it indicates a significant loss in bearish momentum, which could signal a potential trend change. Here we have gold on the 4-hour chart. This is the latest market structure schematic. If we bring the schematic to the side, this market structure is exactly what we are looking for when we want to trade. A clear market structure, movements with obvious direction and swing points. Now, we can apply the smart money concepts to find opportunities to go long with the dominant bullish direction. Or, if the price breaks the latest swing low to the downside, we can take short entries until we reach the next important key demand area. On the contrary, look at this chart. This is the latest market structure schematic. The market is continuously validating the major swing highs and lows to both sides, leaving us with no clear direction. This is the time when we have to stay away from the market until we get a clear bias. Knowing when not to trade is as important as identifying the right time to execute one. Also, always pay attention to upcoming major news, because they will significantly impact the price without regard to technical situations.